My name's Mariah Ybarra, and I've seen many of you in my various other sessions I've had this week, and have enjoyed working with all of you and many of you over the years. I've been doing HOPWA TA since the very beginning of HOPWA in 1991, actually, before the regs came out. And so, although I am not an accountant, my particular work is involved with budgets. Obviously, when you're dealing with grants, you have to deal with budgets, and so part of that is being able to understand how budgets are structured. So this speed session is a topic in and of itself that can take a lot of time and actually be a good day's training, but we're going to briefly discuss indirect costs as they pertain to HOPWA and pertain to how you set up your budgets and to help you understand how HUD really prefers to see HOPWA budget structured. Believe it or not, there are many different ways of setting up budgets around the country with different programs, so we hope we can bring some clarification to you. Can I ask how many of you in the room are accountants or CPAs or do book work every day? And aha, that's what I was afraid of. You intimidate me. Please feel free to join in and ask questions and provide clarity if I miss a spot along the way. How many of you are program folks that have the opportunity to look at your budgets and kind of know how the money flows through your agency? That's great to know too, because there are some agencies that don't necessarily include their staff and program folks in the actual budgeting and the flow of the money, and you'll see why here shortly it's important to do that. So we get a lot of questions about program service cost or service delivery costs, indirect costs, and part of that's because there are some gray zones about it, and there also are various interpretations as to, and names, nomenclature for some of these terms. So understanding the federal cost principles and their implementation in your activities is critical. And the most important thing is being able to define a common technical term to facilitate discussion with your staff in our group together. And then we would love to be able to provide some descriptions and examples of these indirect costs, which I will do, but I'm hoping we'll have time to hear from some of you others about your budgets. And we want you to be able to provoke questions and thoughts, and maybe even questioning why your organization does one thing a certain way and something else another regarding how you classify your dollars. So we know the goal of our whole institute is to ultimately end the role of HIV/AIDS epidemic. So the first thing to really clarify, and for those of you who haven't been as involved in a budgeting process, is really understanding clearly what is a direct cost and an indirect cost. So always think about direct costs as those costs that directly relate to performing your HOPWA activities. The work you do with the HOPWA clients are the direct activities, but they are also the objective of the money. And then indirect costs are identified by thinking of them as serving a common purpose or joint objectives with your organization as a whole. Now, where it can be confusing, and we'll start picking some of these apart, is that direct costs, some can actually be classified as indirect, and indirect costs, some of those can be classified as direct costs. And so there are ways to address that. So examples in working with federal funds in determining a direct cost from an indirect, the example might be the salary and fringe benefits paid to a case manager, a rental assistance check paid directly to the landlord, staff time, meeting and qualifying your clients, and the home visits you make, tracking your mileage and destinations and dates, etc. All of those are eligible direct costs. True, and we call this true and total, meaning that if we use TBRA as an example, here's an area where we oftentimes finding people classifying direct costs as an admin cost or billing it to a different HOPWA activity. So using TBRA as our example, the staff time to qualify a client and doing an intake, if they're coming into TBRA, that staff time should be allocated to TBRA. Once they're in and you're working with them on stability and providing case management, that may be billed to another grant source like Ryan White, or it may be billed to HOPWA Support Services. So understanding the things you can bill as a service activity and other things as more of an oversight. And of course, rent and utilities paid with HOPWA dollars, including the time to cut checks and mail the checks and those costs, that can be a direct STRMU or TBRA activity. Sometimes organizations say, well, we don't have enough money in our admin to cover these costs in the accounting office. Well, that's because this can be a direct cost. The time spent cutting checks for the general agency oversight, paying the rent at the organization, those kinds of costs that you would do anyway to support your agency, those are administrative and oversight costs. Indirect costs are the costs of goods and services that are common, spread across different program centers. When most organizations have multiple funding sources, the era of sole source funding has been gone for a long time. And so beginning to really narrow down which costs go to which grant and which activity. So we've seen grant accounting done for years and years, but HUD is emphasizing that even within that grant source, your cost allocation planning and your activities and your budgets narrow it down so that your staff who perform TBRA, STRMU, some admin responsibilities, that their timesheets reflect which activity that they're working on. Because that is the only way to ensure that the true cost of doing that activity is reflected. Just as a note, admin costs are, as we said earlier, sometimes under indirect, and sometimes they may be directly related to HOPWA. And in the case of HOPWA, those costs are both, and we look at oversight of the program, really narrowing it down to HOPWA activities and oversight and coordination being an eligible HOPWA admin activity. Here are some indirect costs that include your rent costs, utilities, insurance and maintenance, and expenditures related to shared space. You've got these other administrative and executive team functions that support multiple areas in the organization. Fundraising is an administrative cost. It is not a direct cost. Some examples also with transportation and staff expenses that benefit multiple programs would be indirect and divided up and prorated among the different grant sources you have. Depreciation on buildings and equipment can be an indirect cost. However, when you have direct costs to operate a facility for persons with AIDS, that might be a direct operating cost. So really teasing out these different threads to identify what is HOPWA specific, and if we didn't have this activity, we wouldn't be serving HOPWA. That's your direct activities. Administrative crosses and indirect cross all the agency programs, general admin. We always recommend doing a good cost allocation plan, and a cost allocation plan can be complex or can be simple. What we need with HOPWA is something in between. If you have multiple grants, your plan at the beginning of the year identifies what money goes to what activities, to what grant sources, making your best projection as to where you're going to classify the time that people spend and the dollars that are spent. So those are called cost centers, and for those of you who've never done a cost allocation plan or grantees that don't require one, it's important that people know that they must work at honing in on which activities, which daily tasks are directed toward each cost center so that, number one, you can bill it correctly, and number two, these are the costs that get identified in your budget that go into IDIS so that HUD knows what they're paying for, basically, through IDIS and your year-end reporting. Each cost for the same purpose must be treated consistently and similar as either a direct or indirect. Clarify that. It can't be direct one time and then, oh, well, let's make it indirect this time. It needs to be consistent and applied across all expenditures within your agency budget. So we've talked a bit about shared costs. So that is really those costs relative to the benefit of the respective program activities. Ryan White costs are very different than HOPWA costs, and I ran programs where I had 24 grant sources. My cost allocation plan was a nightmare, but once I got it set and all of my funders agreed these are appropriate cost centers, and my timesheets then were able to reflect those for all my staff, it became a rote activity. It just seems daunting at first, but believe me, cost allocation plans are invaluable. So of course they need to be reasonable for the type of program and activity, consistent with the generally accepted accounting principles, GAAP, and they need to be looked at each year when you're doing your development process. And what I always say is, besides your program directors, once your budget plan is set, sharing that with your program staff so that they really get a clear idea of why their timesheets need to be completed in a certain way. Because by you documenting in this area, the money that gets paid out will be accounted for in that same area, for example. So admin costs in general are the overall program management, budgeting, coordination. HOPWA really does narrow it down. In some programs, admin can be much broader and include many other things. But it can include the salaries and benefits for personnel as well as third-party costs for legal, accounting, and audit services. Now, for HUD, it may include goods and services required for administration, including equipment and insurance and supplies and such. Admin can also be indirect. As I say, if you have an admin staff who's working on all the programs in the back office with your accounting division, that person's time is going to be divided up based on a prorated amount to each of the programs they work on. That's general admin, and it gets prorated then to the HOPWA admin line item, which is limited to 7% of your overall grant award from the grantee. However, paper, supplies, pencils, the time it takes to administer your TBRA program, your support services program, those costs are specific to deliver your HOPWA activity. So a portion of those can be considered a direct service delivery cost, in addition to staff time and rent subsidies and such. So this is why I can't emphasize enough that even your accountants have a good conversation with your program folks, because your program folks know what the activities are more directly than some administrative staff may know. There are three basic methods for allocating these costs, and this is an area where we won't go into great detail. We've always got resources, your PowerPoints that are on your app. This one and one that's more in-depth should be there, but there were some changes in Appendix 4 of Part 200 of the Code of Federal Regulations that talk about the types of indirect cost rates that are federally approved. Simplified allocation, direct allocation, and what is called the de minimis indirect cost rate. And they're all pretty, there's some similarities, but there's some different. Here explains a bit more about the simplified method, where the use of all of an organization's major functions benefit approximately to the same degree. We don't see that very often in the services we provide when they're housing and case management and other sorts of activities with other funding. We actually don't often see as often a simplified allocation method, which are the total direct costs, excluding the capital expenditures and what HUD considers distorting items, such as subawards you might have, contracts for $25,000 or more. Simplified does look at direct salaries and wages or creates another basis. Remember, we're looking at these as your basis for defining costs. Organizations with greater than 10 million per year would have additional requirements. I would say that most of the organizations I've worked with have direct allocation methods because you can charge the admin and clerical staff to all the 4 different areas listed here by your allocation planning, your cost allocation plan. So you've got your admin, clerical, you've got the individuals that are identified directly with a program, and that's monitored through their timesheets, what activities they work on. And such costs are included in your budgets and generally have approval. You have to submit this to your grantee if you're a project sponsor, and certainly through HUD monitorings of grantee organizations. You've got oversight there to some extent with your approvals. Costs that are being classified as direct cannot be indirect. They cannot be both. It's double dipping, as it were. Again, you'll see that this method is actually a way to clearly pull apart the management and business functions from the program functions, and another note here saying that fundraising under the OMB, Office of Management and Budget Regulations, are never eligible for HUD reimbursement. That's why, since the era of sole source funding is over, you all are responsible for bringing in unrestricted funding through your fundraising efforts to cover these costs that are not federally allowable. Now, prorated indirect costs are treated as if they were direct costs and assigned to one of those particular HOPWA activities. And some of those then work terrifically well as your direct activity budget, and some of them then will go to Oversight Administrative General Agency. The de minimis indirect cost rate is something that's new that came out with guidance this last couple of years, and it's called the 10% of the modified total direct costs. And in a nutshell, what the Office of Management and Budget said is that organizations that have never had a HUD approved or federally approved indirect rate, never have had one of those approved, can utilize the MTDC, the Modified Total Direct Cost Rate, which is a flat 10%. There's advantages and challenges to doing this. Large organizations often have what we call a HUD-approved indirect rate approved by a federal cognizant agency. Big organizations do. Small ones tend not to. However, if you've never had one of those and you want to consider this as a great conversation to have internally with your accountant, and if you have any outside accountants that work particularly in this area, they're good to consult with before making a change. But de minimis is including all direct salaries and wages and fringe benefits, travel materials, supplies, up to the first $25,000 of each subaward, regardless of the time frame for spending that award. On top of whatever the time frame is, we know HOPWA has time frames, but it might be different for Ryan White or another program. Once you select de minimis rate for any of your federal programs, they have to be consistent. You can't use direct allocation for one program, de minimis for another, and use something else as a cost allocation plan for another program. So determining whether this is the right method for you is important. So this goes on to talk about, even in your admin category, you can allocate some funds out of HOPWA under de minimis to your HOPWA administrative activities. But remember, HOPWA regs rule by saying you can't spend more than 7% allocation of your grant from your grantee to cover those costs. So you're really, it doesn't really apply to admin is really what the net result is. And you must always make sure that your HOPWA admin is applied correctly based on the amount of money you get from the grantee. Okay. And these are the major things that you will find under any GAAP guidance and accounting guidance, that all costs have to be allowable, reasonable, allocated properly and consistently, and well documented as your basis for drawing that money. So those are the basics. And this goes on to talk a bit about labor costs and how the new Part 200 treats them. And basically, I just want to say that this hasn't changed a lot. The guidance has always said that timesheets must reflect both actual hours worked and not percentages. We can estimate in our cost allocation plan what percent of money goes to salaries and benefits, but your case manager can't say, okay, well, I'm 25% of my salary comes from HOPWA, so 25% of my time on the timesheet is HOPWA. Each day, you must record how much money you spent on each activity of HOPWA, and you can round that down to like 15 minutes. It's not as complicated as it seems once you get started. Electronic timesheet programs are great because they often have them all broken out for you too. So just remember, it's after the fact, and you must be able to reflect those true time splits, and certainly for HOPWA, the only cost you can incur are what's allowable per regulation. And at the end of your 7-hour day, 8-hour day, sometimes 10-hour days, that time must all be reflected on your timesheet.